WatchGuard Capital. Invest your time wisely.
Hello, ladies and gentlemen. I'm Stephen Plug with WatchGuard Capital, and the United States is currently operating on a continuing resolution, which means we did not pass a budget and are operating off last year's plan. The next deadline is December 20th for Congress and the President to agree upon a budget, or we'll have to shut down non-essential parts of the government, or more likely pass another continuing resolution. This got me thinking, how hard would it be to balance our budget, eliminate our deficit, and start paying down the national debt? We could do this by raising taxes, lowering federal spending, increasing the rate of return on public trust investments, or reducing tax deductions and loopholes, which is what this video will focus on. Visit WatchGuardCapital.com if you need any help with your personal finances, including reviewing your own budget. But for now, sit back and relax, and don't forget to share this video and subscribe to my channel if you want to support this cause.
In 2019, the federal government will collect $3.5 trillion in tax revenue. If this dot represents $1 billion, this graphic represents total taxes collected. $3.5 trillion will not cover total federal spending of $4.4 trillion, and there will be a deficit of $984 billion. This is like making $35,000 in a year but spending $45,000. You'll have to make an additional $10,000 in the future to repay this debt, or in this case, about $1 trillion. About half of the federal taxes collected, or $1.7 trillion, comes from the individual income taxes on sources such as wages, retirement income, small business profits, and capital gains and dividends. $1.2 trillion, or about a third, comes from Social Security, Medicare, and disability insurance taxes. $230 billion, or 7% of total federal taxes collected, is on corporate income. The remaining 8% comes from taxation on sources such as excise taxes on alcohol and gasoline, custom duties, and other miscellaneous revenues. From 2015 to 2019, individual income and Social Security taxes both increased by about $100 billion each, while corporate income taxes dropped by $140 billion as part of the Tax Cuts and Jobs Act of 2017, which reduced the top corporate income tax from 35% to 21%. The United States revenue is the largest in the world by far, but as a percentage of the total economy, it's relatively low at 17% of gross domestic product when compared to other countries. If this dot represents $1 billion in spending, these 4,400 dots equal the $4.4 trillion the federal government spends in 2019. There's a shortfall of 984 dots of tax revenue to cover this spending, and as a percentage of the economy, the government will spend roughly 21% of the United States' total economic output. Not surprisingly, the largest federal expenditure is Social Security at roughly $1 trillion, since it collects 12.4% tax on all wages up to $132,900 for 2019. It's important to note that Social Security expenditures by law cannot add to the deficit. Tax rates have to be increased or benefits decreased if program expenditures exceed Social Security revenue sources. National defense accounts for about $700 billion, Medicare for $650 billion, healthcare or Medicaid for $600 billion, which can and do add to the deficit. Income security includes programs like federal employee retirement and disability at $150 billion, food and nutrition assistance at $93 billion, housing assistance at $50 billion, and unemployment compensation at $31 billion. Veterans Benefits and Services is a separate category from national defense and captures items like income security and medical care for veterans. Education, training, employment, and social services accounts for $135 billion and captures expenditures of $63 billion for higher education programs and $40 billion for elementary, secondary, and vocational training. Net interest from debt, trust funds, and other investments is the most concerning. Interest on debt is expected to be $573 billion, but after allowing for special government accounting rules, drops to $375 billion. I'll make another video in the future, but for now, know that the government doesn't actually have trust funds with assets and investments set aside to pay future expenses. Government trust funds should be viewed more like a line of accounting in a general ledger that will either be paid back through higher taxes in the future, public borrowing, or reducing the terms or defaulting on the program's promises. If you want to know more about this, I highly recommend reading the Financial Report of the United States Government. The Fiscal Year 2018 report predicts that the Medicare Hospital Insurance Fund will be depleted in 2026 and the Social Security and Disability Funds by 2034. If no changes are made to current fiscal policies, our debt to GDP ratio is predicted to climb from 78% in 2018 to over 530% over the next 75 years. That's one lifetime, and the acceleration started this year. I'm nervous about the financial situation the next generation is going to inherit, because the sad part is that our spending on Social Security, Medicare, Medicaid, defense, and other as a percent of GDP isn't the cause, so it's not going to generate a better or more secure future. It's the net interest expense we'll be paying as a society on the debt we already have and continue to amass. It's like we're racking up credit card debt and trying to pay the interest off with the same credit card. And indeed, if we review federal spending trends over time from 2015 to 2019, net interest from debt had the biggest increase from $241 billion to $375 billion, a $134 billion or 55% increase in only 4 years. If we have another 4 years like that, we should expect to pay $581 billion in interest on debt, enough to cover veterans' benefits and services, education, training, employment and social services, transportation, administration of justice, international affairs, and agricultural expenditures. U.S. government spending is actually conservative at 21% of gross domestic product when compared to other countries, so we don't necessarily have to cut expenditures to right the ship. We just need to do a better job of accounting or recognizing the problem, allocating income to expenses at the time they are occurred, and not using debt financing, and optimizing savings and investments to ensure future success. The exact same thing most Americans need to do with their personal finances. One last graphic on this topic. If this dot represents $1 billion in debt, these 22,700 dots represent the total debt of the United States government at the end of 2019. If Americans could somehow do nothing else but work and pay 100% of output and income towards this debt, we would still be 7% short of paying it off, a trend that is showing no signs of slowing down. A lot of the time, people feel financial problems are just too big to address, both at the personal and government levels. But as always, there are actually multiple solutions that could be used to address this situation. I'll go into more depth on these solutions in subsequent videos, but for now, let's look at the least controversial solution: reducing tax loopholes, exclusions, and tax credits. To do so, we'll have to go to the Joint Committee on Taxation website, which is a nonpartisan committee of Congress who assists both houses on tax legislation. Their publications are available online, and the one we'll need to look at is the most recent Tax Expenditure Report, which quantifies economic policy consequences of legislation. Basically, these tables show how much tax the government misses out on collecting because of various tax rules, allowances, and loopholes. At this point, I would like to make it very clear I am not recommending we eliminate the following tax expenditures. I'm going to leave this disclaimer up to remind you about that. I'll post another video where I provide my recommendations on what I think is right for the country and what I think would clear Congress based on which party holds the majority. For this educational example only, I'm going to, without thought, arbitrarily eliminate any expenditures that cost the government $20 billion or more for the fiscal year 2020. The first elimination is the deduction for foreign-derived intangible income, which would cover $19.3 billion of the deficit in 2020 and $70 billion over the next 3 years. The next elimination is the reduced tax rate on active income of controlled foreign corporations, which would cover $76.3 billion of the deficit in 2020 and $240 billion over the next 3 years. The next elimination is reduced rates of tax on dividends and long-term capital gains, which would cover $129.3 billion of the deficit in 2020 and $400 billion over the next 3 years. The next elimination is the deduction for mortgage interest on owner-occupied residence, which would cover $30.9 billion of the deficit in 2020 and $102 billion over the next 3 years. The next elimination is the depreciation of equipment in excess of alternative depreciation system, which would cover $65.8 billion of the deficit in 2020 and $182 billion over the next 3 years. The next elimination is the 20% deduction for qualified business income, which would cover $56.3 billion of the deficit in 2020 and $177 billion over the next 3 years. The next elimination is the exclusion of capital gains at death, which would cover $40.7 billion of the deficit in 2020 and $128 billion over the next 3 years. The next elimination are credits for tuition for post-secondary education, which would cover $19.1 billion of the deficit in 2020 and $57.4 billion over the next 3 years. The next elimination is exclusion of benefits provided under cafeteria plans, which would cover $43.3 billion of the deficit in 2020 and $144 billion over the next 3 years. The next elimination is the credit for children and other dependents, which would cover $122.2 billion of the deficit in 2020 and $370 billion over the next 3 years. The next elimination is the deduction for charitable contributions other than for education and health, which would cover $31.3 billion of the deficit in 2020 and $98 billion over the next 3 years. The next elimination are the subsidies for insurance purchased through healthcare benefit exchanges, which would cover $56.8 billion of the deficit in 2020 and $191 billion over the next 3 years. The next elimination is the exclusion of employer contributions for healthcare, health insurance premiums, and long-term care insurance premiums, which would cover $176.8 billion of the deficit in 2020 and $559 billion over the next 3 years. The next elimination are the earned income credits, which would cover $72.6 billion of the deficit in 2020 and $222 billion over the next 3 years. The next elimination is the exclusion of amounts received under life insurance contracts, which would cover $22.4 billion of the deficit in 2020 and $68 billion over the next 3 years. The next elimination is the net exclusion of pension contributions and earnings, which would cover $244 billion of the deficit in 2020 and $784 billion over the next 3 years. The next elimination is the exclusion of untaxed Social Security and railroad retirement benefits, which would cover $39.2 billion of the deficit in 2020 and $125 billion over the next 3 years. The last elimination is the deduction of non-business state and local government taxes, which would cover $23.1 billion of the deficit in 2020 and $73 billion over the next 3 years. As I mentioned, I wouldn't actually do this, but I would expect Congress to consider it because it would increase expected tax revenues by $1.25 trillion, enough to cover the current $1 trillion deficit with $250 billion left over to start addressing the $22 trillion in national debt. I hope it gives you an idea of the magnitude of action that will be required and sheds light on part of the problem, which is an ever-growing system of tax laws and loopholes. I find it interesting that we review and re-elect our officials every few years, but not the tax laws they pass, and would be in favor of capping tax expenditures at an agreed-upon amount based on previous year's taxes. In 2019, the government could have collected $2.9 trillion in individual income taxes, but had legislation in place to allow for $1.2 trillion not to be collected, so it only had receipts of $1.7 trillion. What if there was a cap of 33% on the previous year tax receipts for expenditures in 2020, or $561 billion? Estimates are that current expenditures will be $1.3 trillion in 2020, which means Congress would have to remove $747 billion of tax loopholes and allowances to hit the new target, which would go a long way towards balancing the federal budget. If we capped corporate expenditures at 33%, we'd have a new target of $75.9 billion, which would require reducing expenditures by $61.5 billion. Once the reduction number goals were formed, we could let Congress debate on what stays and what gets cut, but at least we would know that our financial future was somewhat stable. As I said before, I wouldn't actually carry out this plan as stated, but portions of it are probably appropriate. The next video I'll release will show how adding a few words to legislation that oversees public trust could reduce tax rates and increase benefits. In the meantime, if you have any financial issues you would like help with, please visit watchguardcapital.com and say hello. Until then, relax and enjoy life.